From Deloitte Tax, welcome to the Tax News and Views podcast. In this series, we talk to specialists from Deloitte about the latest business issues and developments. I'm Carrie Falkenhayn, your host for Tax News and Views, and today we're talking about tax policy, but with a very specific focus on what we can expect from a policy and legislative perspective related to philanthropy. Americans provide a tremendous amount of charitable giving. And the tax laws can either support philanthropy by providing deductions for charitable giving, or they can dissuade certain forms of giving. So joining me today to talk about recent updates, as well as what we might expect in future legislation, are Jocelyn Miller from Deloitte's Private Wealth Practice and Deloitte's Center for Excellence in Philanthropy, and also Jeff Coomer, who's from Deloitte's Tax Policy Group. Thank you guys for joining me today. Jocelyn, I'm going to start with you. Recently, the president issued the Green Book, which explains proposals from the president's budget. And this time, the budget includes two proposals directly impacting philanthropy involving private foundations. Do the explanations in the Green Book reflect new thinking on how private foundations should operate?
Generally, no. One proposal would place restrictions on private foundations that are counting contributions to donor-advised funds as qualifying distributions towards their annual mandatory distribution requirement, unless the donor-advised fund grants the money out by the end of the next year. This would apply to contributions to donor-advised funds, the same rule that is applicable to private foundation contributions to other private foundations. So essentially treating contributions to a donor-advised fund just as though they were being transferred to another private foundation. So not new ideas here. It is common for private foundations to meet their required distributions in part with these types of contributions to donor-advised funds, but it's rarer for private foundation to private foundation gifts. So taking the same concept, but applying it probably more often when it is applied to a donor-advised fund than in a private foundation to private foundation transaction. And to be clear, we're talking about what we call non-operating foundations or grant-making foundations, not those private foundations that are operating an active charitable program. So if the proposal were made effective, we'd be watching to see the impact on gifts to donor-advised funds. We might see that the extra administration to make sure that the funds go into the DAF and then out of the DAF by the end of the year. We might find that extra administration is overly burdensome to the private foundations, potentially drying up the donor-advised fund donations from private foundations. So that's the first proposal. And then the second proposal, I think you're talking about with respect to philanthropy, also includes changes of what is in qualifying distributions. If the second proposal is made law, then payments made to certain insiders called disqualified persons would not count as qualifying distributions. And this could impact the day-to-day management of some private foundations significantly if they relied on paid staff that included disqualified persons and then used the salary and benefits expenses related to those disqualified persons to meet their qualifying distribution requirements.
So some pretty significant changes. Jeff, maybe you could comment in your experience, do these items that are in a Green Book or in budget proposals actually come to fruition? And is there anything unique about these proposals that might cause a different outcome?
Yeah, well, I think, Carrie, it's important to take these within the context of a larger tax policy discussion that we have in Washington and on Capitol Hill. And certainly these two proposals do reflect this administration voicing its views on how private foundations should meet their distribution obligations. But I might note a couple of things. First of all, one thing to remember, a White House budget submission goes to Capitol Hill every year from an administration. It is what I might view as an aspirational document. It is designed to reflect the spending priorities of a White House at the time. And then oftentimes there will be perhaps revenue raisers or tax increases and designed to offset the cost of some of those spending obligations. But Capitol Hill every year, when that budget submission is received, they tend to set it aside because it doesn't reflect the legislative activity that actually occurs on Capitol Hill. Another thing to remember is at the end of this, Congress would have to approve this legislation to implement these proposed changes. And I'm not sure I see that happening in the near term, maybe for a couple of different reasons. First of all, when we look at the power structure on Capitol Hill, Republicans control the House and Democrats control the Senate, as well as the White House. So we have divided government. I don't necessarily see currently Republicans in the House of Representatives being interested in tax increase ideas like this. Second of all, when you look at these budget proposals in the Green Book, the revenue raised is really, in the grand scheme of things, maybe not that much. It's about $270 million that was being estimated by the Treasury Department would be raised as revenue for the Treasury over a 10-year period. But remember, to put that into context, the Treasury Department collects a little over $4 trillion a year in total tax revenue. So it's not a very large number. And then the third thing to remember, too, is that something like this would need a legislative vehicle. It would need a bill in Congress to ride along with. It's not substantial enough to move on its own. And I just don't see that happening in the near term. Now, perhaps looking ahead, remember, we are going to have elections on November 5th that will determine which political party controls the House and the Senate and the White House next year. So some of this conversation may change depending on who is in control of what, if you will, going into next year. But it's a little early to handicap that right now. So we'll see how this, once we turn the page maybe into 2025, see how this looks. But right now, I think I can be comfortable in saying that these proposals are pending as part of a Green Book, but not necessarily being considered by Congress.
Terrific. That makes a lot of sense. One of the other things included in the budget proposal was a return of the corporate income tax rate to a flat 28%. I guess you might think that that would make charitable contributions, deductions for corporations more valuable. Jocelyn, can you share any thoughts around that?
Yes. Well, corporate givers often have dual incentives for charitable giving. So there's the tax deduction that could be available against income in profitable years. And then the goodwill or PR, initially at the company, within the company, and potentially external with the general public. And that good PR from giving to charities can come from a well thought out strategy. So everything equal, yes, it should incentivize more contributions, but everything isn't equal. The individual's company's tax situation may vary. Their income management may be predicting a larger tax bill or a smaller one based on expected profits, available credits, or a shift in profits from higher to lower tax jurisdictions. And then companies may find alignment of a charitable project with other strategic goals that are expected to enhance its long-term value or its long-term goodwill. So there are a lot of factors that would go into whether or not the rate alone is going to cause an increase in charitable contributions. And those factors need to be weighed on a corporation by corporation basis.
And Jocelyn, I might just jump in there too and say, I think the corporate rate is something to keep an eye on. Again, I mentioned earlier, I don't maybe anticipate a lot of changes in the tax code for the remainder of 2024. But as we turn the page into next year, we're going to have a significant tax policy conversation in Washington involving the sunset under current law of a number of provisions impacting individual taxpayers at the end of 2025. Now, the corporate rate, as we know, is permanent, but there are other provisions on the individual side, including things like the 199 Cap A pass-through deduction for flow-through entities, marginal rates for individuals, estate and gift tax relief, that are all currently scheduled to sunset. And I could see where there is a conversation where the corporate rate is perhaps increased some in order to offset the cost of extending some of this other tax relief that is so impactful for individual taxpayers. Now, would 28% be a rate that Congress and a White House could agree on? I'm not as convinced on that, but I could see a move to somewhere in the 24-25% range. Again, as a moving piece, as part of a larger tax policy debate that we're going to have next year.
I want to take us back to a topic that Jocelyn brought up, and that was around donor advised funds. I know there were some public hearings at the IRS on May 6th and 7th that touched on the proposed regulations for donor advised funds. Jeff, can you share any takeaways from those discussions?
Yes, there were 2 days of hearings, May 6th and May 7th, where Treasury and IRS officials heard from over 40 community foundation leaders, industry groups, and tax practitioners who argued that the proposed regulations are too broad and could inhibit giving to donor-advised funds and chill overall charitable giving. The proposed regulations released last November are a long-awaited clarification to provisions first enacted as part of the 2006 Pension Protection Act and generally deal with excise taxes on distributions from donor-advised funds. The concerns raised by the witnesses at the hearings echoed many of the same arguments provided by written comments that were submitted earlier this year. Definitions and scope of the proposed regulations was an area of focus, with a number of witnesses noting that certain proposed definitions are overly broad and add uncertainty and confusion to a wide range of charitable activities and charitable organizations. Another issue raised by a number of witnesses dealt with the treatment of personal investment advisors. By adding personal investment advisors to the definition of donor advisor, the proposed regulations could trigger an excise tax on their fees. Also, the definition of a donor-advised fund has been expanded in the proposed regulations and could include charitable organizations that are not necessarily now considered donor-advised funds. Other requests included narrowing the donor-advised fund definition to exclude certain fund and administrative expenses, fees, and reimbursable expenses from taxable distributions. And a number of the comments also addressed the potential retroactivity of the regulations. And don't forget that Treasury and the IRS are also receiving feedback from Capitol Hill, where an April 19th bipartisan letter signed by 33 House members, including over 25 House Ways and Means Committee members, relayed their concerns, including the potential retroactivity issue, the overly broad definitions in the proposed regulations, as well as the potential chilling effect the proposed regulations could have on donor-advised funds and charitable giving.
Jocelyn, what are we hearing from clients then related to these proposed regulations?
It's interesting for our clients. The clients are seeking to understand whether funds or accounts or even projects within their budgets that they have never considered to be a donor-advised fund before might actually be considered a donor-advised fund under the proposed regulations. And then if they are, how might those accounts or projects need to be administered differently than they are currently? The clients are seeing the comment after comment pointing out the perceived flaws in the proposed regulations. And so they are concerned about how far they need to go, how much planning they really need to do at this point. I'm also hearing some discomfort with the unknown about the timetables and next steps, really the general process for how a proposed regulation may or may not end up to be a final regulation. I'm being asked for, well, what comes next and when? And I can't answer that. And then others are waiting for the meteor regulations to come out in the other areas of donor advised funds that were not included in this first round of regulations. So this was part 1 of 4, and stay tuned for additional proposed regulations.
Well, we will do that. Just to touch on one other change, we had during the pandemic an increase in the cash contribution limit for individual and trust donors when they made cash contributions to public charities. That was at 60%. And there's an expectation that it's going to revert back to the 50% that it was before the pandemic. So any chances for an extension on this charitable giving incentive? And if it's not going to change, what should prospective donors think about doing? Jeff, maybe you can kick us off on the chances.
Yes, and I do think that this is something that will get looked at, but again, it's going to be within the larger context of a tax debate next year. And as Congress begins to wrestle with all these different moving pieces, including so much tax relief that is set to sunset for individual taxpayers, this is going to be one of those components. Certainly, Congress has a long history of being supportive of charitable giving legislation. And so I would anticipate that the charitable community will have a receptive audience on Capitol Hill as they look to consider this. But it's going to be part of, again, anytime you look at it in a larger picture, it makes it harder to determine whether or not it's going to end up in a final package or not, just because there may be so many different trade-offs that are necessary in order for Congress and a White House to come to an agreement. So it may be a little too early to tell right now. On the surface, I would say that it has support on Capitol Hill to be extended, but questions of cost and legislative vehicle and all those other things that layer into a tax policy discussion, it's hard to just see where this is going to end up at the end of the day.
So Jocelyn, assuming that there is this chance that it's going to decrease to 50%, what should prospective donors think about?
Well, the individual and trust donors should consider the expected adjusted gross income. So donors will need to do the math, similar to what the effect of the change in tax rate. And then once they've made their predictions, they'll need to consider the likelihood that their predictions will turn out to be realized. Also, is the effort to figure out the benefit larger than the ultimate financial benefit? Sometimes it is. So there's still a lot to think about. However, it would be good news to the sector to have the additional limitation continue. So yeah, stay tuned again for that.
Well, thank you both for sharing this information. We will certainly keep tabs on any new developments. If you'd like more information, you could reach out to Jocelyn and to Jeff via LinkedIn, or you could go to Deloitte.com, and there's really two things you could do there. One, you could subscribe to the email version of Tax News and Views, so you receive weekly policy updates. But you could also search on philanthropy to learn more about our offerings into this area. As always, thank you so much for listening. I hope everyone continues to be well.